Meta just lost two massive child safety related lawsuits. As a result, the stock is down over 15% year to date. But I'm still buying more.
Meta has been ordered to pay $375 million for child safety violations in New Mexico.
That $375 million lawsuit from New Mexico is the single largest child safety judgment in the entire US tech history. On the other hand, Meta crossed $200 billion in annual revenue last year for the first time ever in its history. That cognitive dissonance, with fear on one side and fundamentals on the other, is the exact space where opportunity lies. By the end of the video, you'll know exactly whether Meta deserves a spot in your portfolio or not. Let's start taking a look at the bear case here. It's the reason why we're having this conversation. Sure, you've all seen the headlines. This week's verdicts are not what actually has investors worried. It's the fact that there's a real possibility that Section 230 liability might get a reform.
You overcame Section 230 motions that Meta and some of the other big tech companies have been protected by for decades at this point.
For a quick synopsis on Section 230 liability, it's a 1996 federal law that has shielded Meta, Google, and every other major platform for being held legally responsible for the content their users post. If someone posts something harmful on Facebook or Instagram, Meta has historically not been the one on trial. Section 230 is a reason why, but there's growing pressure in Congress to reform or narrow this protection. If Section 230 is weakened, every single pending lawsuit against Meta becomes meaningfully harder to dismiss. That change in liability exposure grows from being manageable to potentially overwhelming. I had $135 billion in annual capex spend, and that squeezes the margins from both directions. And that's a real recipe for a bear case. So it's not the $375 million check that has people worried, but it's a structural shift in legal exposure. That's the real risk right now. But I want you to keep that in the back of your head, because what I'm about to show you is why I still bought anyways. So at the time of recording this, Meta closed today at $547.54 per share. Its 52-week high was $796.25. That's around a $250 drop. But if you take a look behind the curtains at Meta's actual fundamentals, you'll see that revenue is growing at over 22% annually, and gross margins are at 82%, and Meta controls 67% of all global social media ad spend globally. That's not a struggling company that's being set back by a lawsuit. Here's a valuation picture. At around $547 at the time of this recording, Meta is trading at roughly 18x their forward earnings. That's less than the entirety of the S&P 500 multiple. And we're talking about a company that's growing revenues at 22%, with 82% gross margins and $81 billion in cash. Meta's 3-year average PE is about 26.5. If that multiple simply reverts back to that average on their most recent earnings per share of around $29.75, you get an approximate of $788 per share. That's roughly 44% upside from this price. And this isn't because anything fixed itself. It isn't because any lawsuits went away. It's simply because the market stopped pricing in the worst case scenario and started pricing in the business. Now, I can probably guess what you're thinking. What about Reality Labs? What about the margins compressions? Isn't that just a money pit with lawsuits on top? Fair question, but let's go through them. Reality Labs, Meta's AR/VR division, burned through about $19 billion in operating losses last year. On top of that, they only made about $2 billion in revenue. If it were a standalone company, it would have been bankrupt years ago, but it's not a standalone company. Meta has the family of apps. Facebook, Instagram, WhatsApp, Threads. Those generated over $196 billion in revenue last year. Meta has been funding their Reality Labs moonshot out of what is essentially petty cash for them. And here's something that the headlines are not fully capturing yet. That moonshot is being scaled back. In January of this year, Meta cut roughly 10% of their entire division and closed several internal VR studios. But that money that they're saving isn't just going away. It's being redirected from the AR/VR division to their AI infrastructure. And on the margins, yes, they are being compressed. Without context, that sounds alarming, but the context is everything. This compression isn't representing a deteriorating business. It's because of the $135 billion AI capex spend that's being deliberately front-loaded by the Zuck. Meta's objective is to build the infrastructure before their competitors, and their margins are taking a hit for that. So instead of asking why the margins are being compressed, the right question to ask is whether this AI capex spend will actually pay off. Here's my take, straight up. Meta is a dominant business in a temporary identity crisis. Those lawsuit headlines are real, but they're not existential. The cash covers them before breakfast. The margin compression worries are real, but they're deliberate, and they're deliberately temporary. But what is also real is 18x forward earnings, 22% revenue growth. I added to my position this week because the math says that the market is pricing the fear, not the business. But I want you guys to do your own research, not just as a disclaimer, but because without real understanding, you're just a passenger, not an investor. But what do you guys think overall? Do you guys think Meta is going to have a positive return on their 135 billion AI bet? And do you think there will be an actual Section 230 liability reform, or do you think that this will get appealed into oblivion? Drop your answers in the comments. I read every single one, I promise. And if you're enjoying this video, drop a like. And if you enjoyed this level of analysis, subscribe so you never miss any future videos. But nevertheless, remember to stay hydrated. Take it easy.